Welcome to the Dividend Talk podcast, episode 180 Early Retirement on Dividends. Hey guys, welcome back to another episode of Dividend Talk. Today we are joined by Nelson, also known as the Canadian Dividend Investor, who talks about his journey into retiring early solely from dividends. Of course, we give our own unique European flavour, we discuss some news of the week, and answer all our questions from the community. See you on the inside. Hey, European DJ. How are you, my friend?
I'm actually doing really well, Derek, today. I mean, it's the end of the week. It's still cold outside, a lot of snow, but we have a great guest today on the show. Also, the stock market was quite volatile this week. This week I saw, but we don't really check our portfolios during the week or something like that. So I'll maybe look a bit at the damage tomorrow, but hopefully it also will give me some great opportunities again. Because on last week's episode, remember where I spoke a little bit about that there's like nothing to buy, and I was like frustrated. Well, you know what I learned first of all? Last Monday was Blue Monday.
Yeah.
I had it already a bit early, I think. And yeah, but it was really nice to see in the community. Many people gave some great ideas, and I want to also thank for that. And it gave me really some inspiration. For instance, one of those learnings that I took away from that, I think it was Bas Vervaart, I think from the Facebook group, he mentioned something like, you know what, if you are facing such a thing, why don't you buy such a company that often felt overvalued that you just want to have in your portfolio? Because anyway, you don't need to bother then so much, and it's may also give you more like instant gratification or something like that. And it really stuck with me. So maybe I'll do something like that next time when I feel like that.
Yeah. Well, I have to say, you look like a completely different person this week. Last week, you were fed up and didn't know what to buy, and now there's a big smile on your face. So I'm glad to have the old European DJ back. But as you said, we have a nice guest on today. It's January, and we always seem to have somebody from Canada on our show in January, and we are keeping that trend up. And we have Nelson, known as the Canadian Dividend Investor. Nelson, welcome to the show.
Well, thanks for having me, fellows. And, I think that every January you have someone on from Canada because it's so damn cold here that we have nothing else to do besides to sit inside and go on podcasts. So I'm from Edmonton, which is a city in about sort of the middle part of Canada in terms of north-south. And last week it was minus 40 here. Which Celsius. Which is it gets to about minus 40 kind of once every 2 or 3 years. So it's a kind of a big deal when it gets minus 40. But when you go outside when it's minus 40, it's within minutes that you're you get frostbite and then bad things on top of that. So you just don't leave the house when it's minus 40. So I think that's what we're all doing here in Canada, is just hanging out at home and waiting for it to get minus 40 so we can go on podcasts. But I'm happy to report it is a balmy minus 16 right now, which feels great compared to minus 40. But no, I digress. Thanks for having me, guys. I'm Nelson. I'm the Canadian Dividend Investor. I kind of retired from corporate work at the end of 2022, and now I'm sort of a full-time investor, kind of part-time investment blogger. You can find me at CDI Newsletter on Twitter and at CanadianDividendInvesting.com.
I mean, that already sounds awesome. I cannot wait to get into asking some questions. We always talk about retiring and what we'll do with our dividends. So it's going to be, I'm really interested. I can't wait to dig into that. But before that, we'll run through some of our usual segments of the show. And the first one we usually do is we look at some of the news of the week. So I'm wondering, have any of you guys, anything stuck out for you this week?
Well, look, you know that Davos is going on, right, in Switzerland.
Yeah.
And it is maybe not directly related to dividends, but this new president of Argentina, Javier Milei, he gave like a half an hour speech there to an audience. You need to imagine there all the world leaders in the audience there, bankers, the wealth is sitting there, and he was giving a lecture on capitalism effectively and how the Western world fell into the trap of socialism by, for instance, all the regulations putting on companies, therefore not allowing them to grow. And it really resonated with me. And, I'm not a fan of populists and such, right? And what he's doing to Argentina, I consider that a very risky experiment. But for instance, I'm still surprised, like, for instance, how the airlines were built out and such over the last few years ago, how banks are continuous to be built out while they are gaming the system continuously, having billions of dollars of fines. There seems to be something and similar in Europe that we don't let poor companies that are poorly managed go bust anymore. There's all the time a bailout or something like that, which the taxpayer pays for. And effectively, he was addressing this, that the Western world started to do this also with printing money and such, that this is not helping capitalism. And he was giving a lot of facts about why capitalism is the best thing that ever happened to humankind, because 90% of the global population was lifted out of poverty because of it. Yeah. So his views I consider still a little bit extreme, because it made me thinking, like, in the sense, like, okay, if it's really like pure capitalism and nothing else, like, is that really fair? Will it really reduce the wealth gap? I don't know, but I'm very curious how this plays out in Argentina, because if it plays out well, I could see this blowing over back to the West and here, because I'm sure no politician would dare to put such measures in place right now, because they will not get elected effectively, specifically not here in Western Europe. But as a capitalist myself, I found it very interesting to listen to such a person. It's really a different voice, a little bit contrarian to what we usually hear.
Yeah. And when I'm listening to you, I haven't seen the video and I haven't seen the clip of
I'll
that.
put the link in the description of the notes.
Yeah, but you're dead right. I mean, some companies are almost too big to fail now, is what they're doing, and they're constantly being bailed out. And I don't really agree with that either. But as you said, there's probably a middle ground, and there's somewhere to meet in the middle. And I think that's probably what us Westerners are probably looking for. Let's see how it plays out in Argentina, and do a scaled back version of what he's doing if he is successful.
Yeah.
Yeah, I look at what's happening in Argentina with him, and it's fascinating. It's really, really interesting to watch. I think there's about a 50% chance that it turns out very well, and he's sort of remembered as kind of a revolutionary, turn the corner guy in Argentina. But also there's a 50% chance that this just blows up in the biggest way.
Exactly.
And I, for one, am just going to keep watching and see sort of what happens, because I can't handicap it right now. I don't know what's going to happen, but it's entertaining, and he is definitely a breath of fresh air compared to every other politician on the planet.
Yeah, I'm crossing my fingers for him that it plays out well. I really hope so. It would be really nice. We need a hero a little bit in this space.
Yeah. And back to more dividend-related news then. There's a report by Allianz Global Investors, and they are predicting or stating that European shares are expected to rise by 6.5% this year. That's good news for us, right?
Well, if it so happens to be true, right? You know what we say about bankers sometimes here. But we also know that European companies typically have a dividend payout policy based on, for instance, a 50% payout from earnings. So it suggests also that earnings are growing. I can see that as well. What I found really interesting is, like, do you know that last year in Europe, companies from the MSCI Europe index paid out around 407 billion euros? Yeah, and they expect this to grow in 2025 to approximately 460 billion euros, which is almost $500 billion, let's say, in dollars. I found this really mind-blowing. And I said, what's even more, for the past 40 years, what they mentioned, almost 36% of the total return came from dividends, while in North America was 22%. And we know that there are a lot of higher yielding companies in Europe, right? But again, it's due to the payout of earnings policy. But we also know that dividends are typically less safe because, if the earnings decline, we get all these dividend cuts as well in Europe. So yeah, I hope my financial independence plan requires a 6% organic growth in dividends. So I'm really hoping that this will be the case, because then I will hit my numbers again in 2024.
Yeah, but I always find these reports fascinating, because when they come out and then we start to see trends before inflation and interest rates started rising, we were both commenting on the podcast that you could see companies were starting to report this nearly 12 months before we started to see it play out in real life. And now we're starting to see these reports come out. We still have inflation, we still have interest rates in the news. So it might be a sign that we're starting to come out of that period slowly. And maybe 6 or 8 months down the road, you might start to see more positive news from companies. So, but it's interesting. We like Europe. We always think American companies better dividends, but then you see Europe is actually quite well. So
yeah, well, they need to get us this implementation that we can get our taxes back from the other countries, because until then, dividend investing continues to be a struggle.
And I'm assuming North America here includes Canada as well, I would assume.
For me, one of the reasons why I embraced the dividend strategy was because dividends in Canada are taxed very well for the individual investor. You can actually get to about $60,000 a year in income from dividends and have it be tax-free, as long as it's your only source of income. So for me, that was a big inspiration. As for European stocks, first of all, I really enjoyed the precision of that report, saying they're going to go up 6.5% rather than, say 6.7. I enjoyed that. But, I know Canada much better than I know Europe. But what I do know of Europe is that there are some interesting dividend stocks that, valuations are much, much lower in Europe. And, you get more attractive dividends because, like you guys mentioned, the dividend policy of paying out the percentage of earnings. And it seems like nobody really cares about European dividend stocks, at least from a North American perspective, because everyone values sort of that consistent kind of 6 to 8% raise every year. And you get into a situation where if nobody values European dividend stocks, then they become more attractive from a capital gains perspective because they're just so much cheaper than in North America. So, someone who thinks that certainly the tech market in the US looks quite expensive, then that kind of makes me more interested in a place like Europe and that much cheaper overall valuation.
Yeah, I think it's also harder for you guys over in North America to buy European stocks that are not ADRs or something like that. I think it's actually quite difficult. From what I read online anyway, it looks difficult for you to invest. So I can understand why you would stick to North American stocks, to be fair.
Yeah, I would need an Interactive Brokers account to buy in Europe. The rest of the brokers in Canada, it's Canada and it's US, and that's it.
Okay, awesome. Dividend hikes. We've had, it's been a slow start to the year, I have to say, in terms of dividend hikes. The biggest disappointment this month was BlackRock, only hiked at 2%, which was quite low. I mean, it is their 15th straight year, but 2% is disappointing for a company the size of BlackRock as well. So that caught a lot of investors.
They own the world, right? So you would have expected a 6.5% here.
Yeah. And there was a couple of others. What's the other one? Consolidated Edison, ticker symbol ED, which became a dividend king, which is big news, with a 2.5% boost to 0.83 cent, or 83 cent per share quarterly.
Yeah, and then also I would like to call out Schlumberger. Very interesting if you are into oil and gas stocks. it's effectively giving a lot of the equipment to the industry. Probably you know this one as well, Nelson, because you've got a rich oil and gas industry in Canada. So it's also nice to see Schlumberger coming a little bit out of the depth again, because also during COVID, it was mainly the oil majors that could keep their head above the water, but all the suppliers were crushed in the supply chains, right? So it's good to see them picking up again.
Yeah, I deliberately left that one for you because I would not be able to pronounce that name.
What I was just going to chime in and say that Schlumberger is even in Canada, they are if not the biggest kind of oil field services company, they're definitely up there. So that's a big worldwide operator, and in something as volatile as oil, it's usually a good idea to stick with the big guys, whether it's in oil producers or oil services.
Good. So we might move on then to our main topic, and that's to chat to you. The theme of this is going to be around early retirement on dividends. I mean, this is fascinating to me. I think it's one of the first. I don't know if we've had anyone before that has retired on dividends, so this is quite interesting. But maybe we'll go back to the very beginning. Do you remember the day you started, or how did that look? Were you even a dividend investor?
Well, I'll start with just sort of my investing journey and kind of how it ended up in dividends, because I started out as a real estate investor, and that was my dad was a real estate investor. We always had rental properties growing up, and one day I was 16 and I was working at the local Dairy Queen. Do you guys have Dairy Queen in Europe?
I don't know. No.
It's a fast food chain owned by Berkshire Hathaway. And so I'm working at Dairy Queen. I get a phone call, and it's like, hey, my dad was working on a light at one of his rental properties, and a ladder that was about 20 years due for replacement collapsed underneath him. He broke his leg. So that summer, he's at home, and I start talking to him about investing, and he shows me how he invests in real estate. And I was hooked immediately. It's like, this is great. So when I turned 18, I had saved up some money from my working part-time in high school from that Dairy Queen job, and I used it to put a down payment on a rental property. And then I bought another one, and then I bought another one, and then real estate in Canada had a very good couple of years, and the numbers didn't really work out anymore. So then I diversified into private lending, which was sort of people who wanted mortgages that couldn't go to the bank or that got rejected from the bank, that I would go in there. And so my dad and I did that for a while. And, nowadays you can just go on the internet and type in, I'd like a loan, and there's 20 guys who are willing to, at least consider you. Well, back then there wasn't really anyone to do it. So we kind of had this local monopoly, and that was quite successful for us for a number of years. And then it wasn't until about 2010, 2011 that I really started getting serious about investing in the stock market. Our mortgage business was kind of dying up. So that was really when I started investing in the stock market. At that point, I've been investing for 10, 11, 12 years. And I started out as a deep value investor with a concentrated portfolio. And that didn't work out. I made a couple of bad decisions, and I said, this is nuts. I don't want to lose 10 or 15% of my portfolio at a time. Now, of course, most of the portfolio was still real estate at that point, so it wasn't a huge loss, but I learned that lesson, and I kind of started looking for sort of higher quality companies rather than cheaper companies, and really kind of started looking at it and saying, okay, what do I want from these investments? And obviously I wanted them to make money, but most importantly, I wanted that dependable source of cash flow that I could use to retire early. That was always my goal. That was always kind of, when I invested, what I wanted from it. And so I kind of figured that out, and then started putting kind of everything that I could into these dividend stocks, and did that for pretty much a decade. And 2021, 2022, it kind of got to the point where, okay, I'm replacing my salary with dividends. I want a little bit extra, so I sort of stuck around for about a year afterwards to kind of get that bit of a cushion. And then at the end of 2022, I said, okay, that's enough. I retired from the corporate world, and I've been living off my dividends ever since.
And do you still have that real estate portfolio as well, or did you go all in on dividends, or did you? Is it a mix of both?
It's all in on dividends now. When the values kind of, Canada is has done quite well in terms of our real estate market, just kind of keeps going up and up, and it got to the point where the kind of the rate of return on the rentals was quite low. So I said, okay, I'm going to sell the portfolio and just focus 100% on dividends. I still have a couple of the private mortgages that I did before that good long-term people that have paid for a very long time. So I hold those, but it's 90% plus dividends at this point.
Nice. Hey, and what I find really interesting, right? And we got this question lately more often from some of our listeners, like, there's this thing as dividend investors at a certain moment that you get into the boring middle. Yes, so you have like kind of in the beginning, it's like you fall in love, you're reading every book, whether it's dividend investing related or the Peter Lynch book. Everyone goes through this kind of discovery phase, and then hits the boring middle after 3-4 years or something like that. And then at a certain moment, and I'm not there yet, I expect that this kind of moment comes that you think like, whoa, shit, in 2-3 years or something like that, it may actually become reality, right? How was this for you, and how did you go through this? And let's say from an emotional, maybe that's the wrong word, but like kind of psychological point of view.
So the readers are right. There's definitely a boring middle, and I certainly went through it. For me, what really kept me going was I put all of my dividends in a spreadsheet. I still have that spreadsheet. I still update it every time a dividend goes up. And I just kept putting the dividends in there, and I kept looking at that amount that was at the bottom. And at first it was, okay, that's enough to kind of cover my cell phone bill or to cover my electric bill at the house, and then it was, oh, that's enough for a car payment, and then hey, that's like getting close to our mortgage payment. And just for me, it was recording it and watching those numbers go up was a big motivator, and I think really helped me from sort of getting bored in that journey. But for me, it's very interesting for me to research stocks, to read about that stuff, and so I was lucky enough that I would get into it, and it's just sort of, I like reading about that stuff anyway, so it wasn't really that boring from that perspective. It's a grind at some point for sure.
And how when did it start? When did you get this feeling of, oh wait, the finish line is coming? That you really started in your mind to think about your retirement date effectively, right? And you mentioned you want to stay a year longer. When was that? Was it like shortly before, or did it, because you're then in the boring middle, let's say? When did it start to turn, and why at that moment?
So it was sort of in 2020 that I was fortunate in the fact that when the market kind of fell in the early part of 2020, that I got paid out on one big mortgage that I still had remaining, and I had a pretty good chunk of money to invest, and then the market crashed, and I was able to go aggressively there at that point.
Mm-hmm.
And then that was really when it was like, okay, like I know that it was a amount of dividends every year where it's like, okay, this is sort of I can survive on this. And I think that with the dividend raises, that this is kind of enough for me to kind of keep going sort of for forever. And then at that point, it was kind of like, okay, like what do I do? Do I kind of get out? Do I do I retire? Like, what do I do? And what happened was we were living in a small town, and we decided to move because my wife is from a large city, and she didn't like living in the small town anymore. So we moved to a medium-sized city here in Canada, and that was kind of a nice little rejuvenation for me, where it's like, okay, I'll go back to work for a little bit, because I was with the same company, but I started a new job, and I said, this is kind of neat and interesting and fun and exciting. I'm going to do this for a little while, and then build up a bit of a cushion. And so then I for the next kind of couple of years, we were still aggressively saving, and so I built up a little bit more of a cushion, and then the job wasn't quite what I thought it was going to be. So then it was time to pull the plug.
And is your wife still working, or did she retire as well?
She is. She works part-time. She has a very kind of limited. No, how should I say this? She has a very flexible job that she can kind of go in, work for a little while, and then sort of bugger off for a while. So she works part-time to fund her travel habit. In fact, she is somewhere in Europe right now without me, because she really, really likes to travel. I like to travel too, but she's
Awesome.
she's basically retired too.
Yeah, awesome. So tell me, what does a day in the life of a retired dividend investor look like?
Well, the best part about retiring early is the day looks like whatever the hell I want it to look like. And like today, I woke up early because my cat woke me up. I'm gonna scowl at him here. Cat woke me up, but I just came and sat in my office and read some financial reports. I'm looking at a company for the premium newsletter that I run, and then I went and made myself a nice leisurely breakfast. Played some MLB The Show, so that's a baseball game for PlayStation for people who aren't familiar. And then I came and I'm talking to you guys, and then after this, I'm going to go and see a movie tonight. So I just do whatever I want, and every day is different. There are certain things that I do most days. I do like I check my portfolio, but I mostly just hey, this stock is down, what's going on? And then I go and read some of the quarterly reports or the annual report to see sort of what's going on with it. I have some retired friends that we go for 2-3 hour lunches, go for walks around the neighborhood. I was never really much of a cook. I'm a cook now. I'm still not much of a cook, but I can cook a few things pretty well. And there's I watch TV. I'm binging 30 Rock right now, which was a American show in about 2005, 2006. All sorts of things is what I do. Yeah. So it's kind of whatever strikes me at that moment as an interesting thing to do.
And are your friends investors as well? You've mentioned you had a group of friends that are also retired.
Not really. I do have people that I talk to who are investors, who I can kind of get my fix in. Of course, when I talk to guys like you, that helps as well. For the most part, they're sort of kind of, hey, what should I do with this stock or this ETF that I own or whatever. And for the most part, I just sort of try to steer them towards passive ETFs, because I know that someone who is asking a friend at lunch what stock they should invest in shouldn't really be investing in any stocks.
Of course.
But maybe you meant retired friends as people that are like 70 years old, that you're just hanging out with the elderly in the park or something like that.
I am definitely the youngest out of my retired friend group, anyway.
Nice. And do you see yourself staying retired, or will you get back to the workforce? Maybe not in a corporate setting, but do you think you'll go back to work at some point, or is this the way? Is this it for you?
Well, I mean, I do have the website that I run, and it does have a premium newsletter attached to it, like I said. So, the what's it called? The Internet Retirement Police might come out and say, Nelson, you're not actually retired. You do exchange some time for money.
Yes.
And maybe like I don't really give a shit what what people say. It's like it's, for me, it was always is exchanging time for money my primary goal. And if the answer is no, then it's like, well, I'm retired. So exactly. Do I think that I'll get back to the point where I exchange time for money and kind of make that my primary goal? No, I don't think so. But at the same time, it's like there's definitely interesting things out there. And I look at things sometimes and I say, hey, it might be interesting to learn about the hotel business or something. And so how do you do that? Well, you go and work in the hotel business. And so, I'm not going to close the door on that entirely, but for right now, I'm really enjoying retirement, and I don't really yearn to go back to work. And in fact, I talk to my friends who are still working, and I say things like, how do you even have time for a job? Like, I don't know how I had time for a job. Which, guys, let me tell you, that just pisses them off. Don't do that.
It's probably one of my favorite answers we've had on this show, I have to say. It was quite awesome. But yeah, I mean, it must be so refreshing just being able to do what you want. Because we've had a couple of different episodes on this show and about that subject, about what we would do, hypothetically, what we would do when we leave. And I think we've given nearly different answers every time because you constantly evolve. And I always feel I need some sort of purpose. I feel like I'd need to work, but it's hard to know unless you actually do it, isn't it? It's hard to know. But I mean, to me, it's honestly really inspiring to listen to you talk and actually to have someone say, I don't give a shit what anyone thinks. I'm doing it my way. It's pretty refreshing, I have to say.
But what you're saying, Nelson, is you have now the freedom of choice. You're not anymore dependent on income to provide for your family, that you need to show up. No, you can do stuff when you want it, and I think that's the nice thing about what you're saying.
Yeah, one of the things that when I approached early retirement, when I, it was kind of, okay, what am I doing all this for? It's like I understood that this is my goal and this is what I'm working towards, but there was like I struggled with the why a little bit, where it's like, okay, like what's the point of all this? And I kind of came to a realization one day, and it's like, everyone talks about fuck you money. And I thought to myself, like, what's the point of fuck you money if I'm just going to have the same life as everyone else? And I used I had a coworker who, good guy, and he just, couldn't get ahead. There was always something he was spending his money on. And I realized one day, it's like him and I have the exact same life. We're both going to work. We both come home. We both, kind of like make dinner, relax for a couple hours, and then go to sleep. But it's like I've been working towards a goal for 20 years, and he had been not working towards that goal, and yet we had the exact same life. And to put it kind of more succinctly, like, what's the point of having fuck you money if you're not going to say fuck you? Yeah. And so that's it. So at some point, it's like you either sort of flip the switch or pull the trigger or whatever you want to say and get out, or you would really kind of have to struggle with that motivation, because like, why keep saving and why keep making those smart decisions if you're not going to ever do anything about it?
Yeah,
true.
It's a very good point. And I'm not there yet, so I don't have that option. But I'd imagine it will be a tough decision to make. How did your wife feel about it? Did you chat to her beforehand, or did she just say go for it?
We chatted about it for sure. For the longest time, she didn't really realize sort of how kind of far along we were, and she's risk adverse by nature, so she was worried that hey, we're going to run out of money. And so I looked and I told her, hey, we're not going to run out. We're good. We built that buffer. And I said, secondly, like, if we do screw up and we have to go back to work, like, how is that such a bad thing? It's like I was working before, and now I'm going to work I might have to work afterwards, but like at least we gave it a shot. At least we we tried it. And so that was a couple of years ago that we first really kind of talked about it seriously. And then I pulled the trigger first, and I just kind of said, look, I'm finished. You can do whatever you want, but just so you know, like, there is enough money for both of us. You don't have to continue to do it. I think she lasted her job about another month, and then she pulled the trigger as well. So
Nice.
she's just, I mean, still works a little bit, but very, very part-time.
And Nelson, tell us then, is it literally now that when you get a dividend come in, you forward it back to your bank account and then you just pay the bills with it? How does this work?
So first of all, I have about a 6-month cash cushion. So 6 months worth of spending of cash in the bank. And then what I do is I let that dwindle down as I spend, and then the dividends sort of show up in my account, in my brokerage account, and then I kind of replenish that account as needed. Sort of the overarching strategy is that my portfolio has about a 4% yield. I take 75% of that, so about 3% of my assets, and that's in the spending bucket. And then I have the other 25% of the dividends that go back into the reinvestment bucket, and I reinvest those. And I was I've talked about a buffer kind of a few times, and that was certainly something that I wanted to create, where it's like, I know that the 4% withdrawal strategy that I have based on the yield of the portfolio, I think lasts forever, and I think will end up doing quite well in terms of dividend income and inflation. But I wanted to just kind of add safeguards, and that's a big safeguard that I wanted to add was just having that little bit extra that I can keep putting away to make both me and my wife feel better about this path that we've embarked on.
And how does your portfolio look? And did it change as you were approaching retirement?
So I definitely have sort of more of a slower growth portfolio than a lot of people would, because when I was working towards retirement, I kind of said that, it's like, I knew that if I created, like, the goal was always to live on dividends, and if I created a portfolio that had a little bit higher yield, I know that I didn't want to get too crazy when it came to yield, because that just opens you up for issues, but I wanted a little bit higher yield, knowing that would accelerate my financial independence journey a little bit, that I could retire a little bit earlier. And so I built the portfolio like that. But what I do now is that sort of that 25% of my dividends that I'm reinvesting those more into growth stocks to try to increase the growth rate of the dividends just a little bit. So it's kind of, my dividend growth rate is sort of in that 4 to 5, maybe 6% range. And I'd like to see it just a tiny bit sort of higher than that. So like kind of get it from, just so I know that even, will inflation be 2% forever like it has been for a long time, or it'll be closer to 3 to 4%? Just in case it is, I want to just add that little bit more growth. But for the most part, it is relatively slower growth and a little bit higher yield.
And is your portfolio then made up of mainly Canadian stocks, or have you got any, probably not European, but even US stocks? Or
it's probably about 85 to 90% Canadian, and then the rest is US stocks. There's a little bit of I own there's 2 Mexican airport stocks that I own outside of the United States. They're ADRs that trade on the New York Stock Exchange. So that's it. And other than that, it's Canadian or American stocks.
Yeah. And as a Canadian, then, are the banks, are they the anchor of your portfolio, or would it be real estate, because you come from a real estate background actually?
It's actually sort of both. They're both about a 15% ranking in the portfolio. I'll talk about the banks kind of first, because Canadian investors absolutely love banks, and of course, we're chatting earlier. Seems like a lot of the questions that the listeners gave us were on Canadian banks, because the Canadian banks are their financials make up about 30% of the Canadian market, which in the United States, I think it's about 10%. They're a big part of the Canadian market. And the six largest banks, and I own all six, they control about an 85 to 90% market share in Canada. So that's a big thing for kind of Canadian bank investors, is that these guys dominate the Canadian banking industry, and because of that, they make the rules. So there's that. And then Canadian banking, of course, they've taken those profits from Canada and they've used it to expand outside of Canada, mostly in the United States, except for Scotiabank, which went to Latin America. And so you've got these Canadian profits, and the Canadian profits are protected, one, because of the oligarchy status, but two is every high-risk mortgage in Canada, so that's any mortgage with less than 20% down, is insured against default by an organization called CMHC, which is part of the Canadian federal government. So what you have is these six banks who are making loans to Canadian homeowners that are protected by insurance against default, which is underwritten by the government. So that if there's ever a housing kind of bust, the government steps in and says, hey, we got you. And this insurance is purchased by the borrower. So the bank doesn't even have to pay for it. So you put all that together, and are mortgages zero risk in Canada for the bank? No, but they're pretty damn close. And that's what makes the Canadian banks so exciting. So what they do is they'll generate anywhere from 25 to 30% ROE, return on equity, which, as far as I know, is the highest in the world. And then they'll expand into, like I said, the US, and then the US operations will have kind of a 10 to 12% return on equity. And you put it together, and it's a pretty good business, and they kind of return to sort of 9 to 12% consistently for the last 150 years. So
wow.
they're
That's
just
really
solid.
amazing. Yeah, so I'm always I don't like banks, let's say, but I think there is something, because you're not the first one. We had also Mike on right last year, and I think Canadian banks are different from that point of view. Yeah, because for instance, also Centrino, maybe one of the listeners that asked a question about was asking, like, so when you think about those six, which are important, is in your opinion kind of let's say the safest or with the highest dividend, like the one that really gives, I guess, the most appeal to dividend growth investors?
So in terms of growth and kind of that highest quality, I think it's Royal Bank of Canada, which is, like Royal implies that it's kind of high quality, but they deliver. They're just a well-ran bank on just about every metric. They're the largest bank in Canada. They've expanded to the US, and they're kind of, smart, prudent Canadian bankers, and it's returned kind of the highest return over time because of that sort of prudence and the better management. The other one that I'll highlight in terms of quality is National Bank of Canada, which is out of Quebec. It's a little smaller than the other the top six. It's the smallest of them, so it has the best growth potential as it kind of moves across Canada. It's really only in the eastern part of Canada right now, and it can expand across the country. And it's the same kind of thing where just good quality management. They just slowly grow every year, and they make smart decisions, and they deliver good returns for investors. Highest dividend yield is Scotiabank, which is the one that expanded into Latin America. And the developing markets went from being like a big investing theme, sort of kind of 2011, 2012, two, they've been left for dead, and nobody likes Scotiabank because it has that Latin American exposure. And so Scotiabank has just hired a new CEO, and he came out and he said, "Okay, we get it. We know you don't like the Latin American exposure, and there's plans to sell it." I think the problem is
Who wants
so
to
they're
buy
big
it?
in they're big in Colombia, say.
Yeah.
They've got assets in Colombia. And then you look at the Bank of Colombia ADR in the New York Stock Exchange, it trades at about 5 times earnings. And
Yeah.
so then it's like, well, who's going to buy Scotiabank's Colombian assets for like 8 or 9 times earnings that they'd want for it, when you can just buy Bank of Colombia shares for 5 times earnings?
Yeah, makes sense.
Yes, the Canadian banks, they always interest me because we hear so much about them. So look, as you said, we have plenty of questions about them, so we might speak about them a little bit more in detail. But I'm quite interested about your blogging career and why you started doing that. I mean, you seem like you are quite busy with your mortgage business, your lending business. You also had some real estate, and then your dividend portfolio, on top of working at the time, I assume. So why did you start? What was the inspiration behind starting that?
The inspiration starting that, I laugh because I know exactly what it was. Is there was I started reading blogs probably in about 2010 or so, when they really started getting popular, and I thought that some of them were really stupid, so I started my own. And in hindsight, it's maybe not the best reason to start something, to stick it to someone, but that's what I did, and I just discovered I just really enjoyed writing, and for me, it's always been this ability to. I feel like I don't understand something until I can kind of write it down and I can sort of explain it to someone else, and that really helps my understanding of something. So that's what I get out of it, and that's why I keep writing, and I'm kind of hopelessly addicted to it. I mean, I've been doing it on the side for a decade now, and it's it's like you get writing and you just can't stop, and that's me. I just can't stop. I think I'll always be doing it in some form, whether I kind of blog sort of professionally or not. I'll still journal, or I'll still whatever, because it just really helps me sort of sort my thoughts.
Awesome. Yeah. I have a similar experience, and I would even argue that it made me a better investor, because also when you write, you don't write only for yourself, you write for others as well. So you make sure you do your due diligence even more than you maybe would do usually yourself. And you get a lot of feedback, right, from the readers as well, that point out other stuff that you may not have thought about, not have seen. So in my case, doing this now for 4 years, and what you're saying is like really resonates with me. I feel the same. It's like just passion, yeah. But also honestly, it really made me a better investor, I would say, because you need to think about, when you, for instance, do an analysis about a company, you need to really think about what do I need to know about this company, right? And what should I really pay attention to? How do you articulate that? You need to sometimes create some G sheets where you do the math and everything about what's really driving this business, and then maybe just make better investment decisions, I would say, or at least understand the risk of the investment also better.
Yeah, absolutely. I have found that exactly what you said, where it makes you just more clear on everything that you're talking about, your understanding, and ultimately that makes you a better investor. I found that as well.
Yeah.
Okay. So,
go on, Derek.
Sticking on the blogging world, do you give advice to beginner investors, or what would you advise beginner investors to maybe start with or look at when they're working in their investing world?
The number one message I give to beginner investors is that if you don't have the passion or the wherewithal to look at financial statements, to research a company in depth, if that doesn't get you going, then stick to ETFs. 100%. And so because like I kind of think of that, my writing is really geared towards sort of intermediate investors and above, just because in my mind, I've kind of, sort of taken the new guys and just kind of said, okay, like I'm not really talking to you versus, kind of talking to someone with a little bit more kind of sophistication. But saying that, I think that if you are passionate about it and you do want to learn more about how to invest and learn about dividends and all that stuff, by all means, start down that path, figure it out. Just be prepared to do a lot of work before you're kind of fairly competent at it. Not to discourage anyone listening. I think that I love this stuff, and I think that other people would love it too if they just sort of got into it and understand it. But
so then maybe before we go to the listeners' questions, any favorite books that you recommend around investing or dividend investing?
Ooh, that is a good question. The 4 pillars of investing, which I can't remember who the author's name is. That one is excellent. There's Jack Dorsey wrote a book on moats, which I don't remember the title of right now. That one is excellent as well. Both of Peter Lynch's books I quite enjoyed. That's all I can really think of right now. I'll tell you guys that at this point in my life, I try not to read investing books. I feel like for me, it's much more kind of beneficial to dig into annual reports and dig into the quarterly reports and things like that, rather than read the investment books.
I think in some annual reports, there's more poetry than you find in the investment books. Good. So maybe we can go then to the listeners' question. And thank you, Nelson, so far, right? This is, I mean, for me, it's really inspirational because I'm at this kind of 60% expense coverage level. So, 4 or 5 years, I should be able to be in your position a little bit. And I can only dream about that now. And the life that you've been describing, that's what I envision. I don't envision to stop working, maybe, yes. Honestly, I like my job a lot now, so I don't really see a reason to step out. But if anything, yeah, of course, just analyzing companies and sharing my knowledge with the rest, that's kind of the dream. But also, I don't know, doing the Uber driving, working a month in the kitchen, like you said, just figure out where my curiosity leads me to, right? So really, I hope to get there at a certain moment in time. But hey, one of our loyal listeners, he's been also on the show 2 times, is Thiago Diaz. And he's been asking, like, what's been the most challenging and the most rewarding things about your early retirement? I think you touched already a little bit on it, but maybe not so much yet on the challenging part.
Yeah, that's a great question, because guys like me will always come on these podcasts and talk about how great it is, and no one wants to talk about the challenges. So I'll talk about 2 challenges that I had, and the first one is getting out of the mindset of exchanging time for money. And when you embark kind of on this, sort of, like you said, letting your curiosity kind of take you in a direction where it's like, hey, I want to, work on something and figure something out, but not necessarily exchange my time for money. Where my default was always, hey, if I'm interested in the hotel business, like I said earlier, I'm going to go work at a hotel. And it's like, well, no, that's not necessarily the best way to do it. And it's hard to get away from that default of I'm going to go exchange my time for money. So that's the first thing. The second thing that I'll mention that for me was the much tougher challenge, and I still struggle with it, is going from an accumulation mindset to a decumulation mindset, where it's okay to take money out of the accounts, because it just sort of kept getting higher and higher and higher. And for 20 years, it was just push and push and push and get a higher net worth and get a higher passive income. And now it's sort of in that decumulation phase. And mentally, that's tough. And I struggled with it. I still struggle with it.
So going back to your mindset, how did you change that? So you mentioned that you need to remove that mindset of exchanging time for money. How did you actually do that?
I can't answer in just a couple of words how I did it, but it was just focusing on the intellectual pursuit and the curiosity part of doing something versus the income potential part of it. And so to kind of use an example from my life, I've got this premium newsletter, and I know that I could sort of embark on a freelance writing career and write for other people and make more money doing that. And I've done that in the past, and it was something that I even enjoyed and everything. But it was, well, no, like, this isn't what I want. I want the freedom to kind of write about what I want and kind of do it my way versus writing for someone else and doing it their way. So it was just kind of a very intentional sort of thing, right? Like, okay, what do I want? What are my goals here? And then sort of working backwards from there, rather than sort of taking that easy path and sort of falling back into the lifestyle that I didn't want.
Yeah, I get you.
It's very interesting, Nelson, by the way. I was expecting something like finding a rhythm, like a daily routine or something like that. But you seem to deal with that quite well.
I mean, for me, I don't know if it's like a ADHD thing or because I have been diagnosed with that in the past. I like routine, but for me, like, it's a special kind of hell if the days look the same, kind of all the time. So that was a big motivation for kind of financial independence, was that I can just sort of do whatever I want in when I wake up, and I don't have to answer to anyone. So that's
nice. David has asked you how your portfolio has performed versus the global stock market index or the S&P 500 since you started.
So I'll divide my portfolio into kind of I've been investing for a little over 20 years. The first half and then the second half. So the first half, I absolutely crushed the S&P 500 because the S&P 500 struggled, as you guys know, during the kind of that 2000 to 2012 kind of period. And that's when I was investing in real estate. And, so I was investing in this non-correlated kind of asset class, and it did very, very well. The most recent decade, kind of the last 10 years, my portfolio has underperformed the S&P 500. There's no doubt about that. I have very little tech in my portfolio, and kind of that's driven the S&P 500 returns. So I have underperformed there. My benchmark that I use personally is the TSX Composite Index, which is sort of the kind of the S&P 500 for Canada, but it's 225 companies. It's not 500. And I've largely matched it, maybe beat it a little bit in terms of sort of the last decade. In the last sort of 4 to 5 years, where I really took, my investing kind of more and more seriously, I have beat the TSX 4 of the last 5 years. And in 2023, I did not. My return was a little over 7%. The TSX was a little over 11. So for the last 5 years, I have outperformed, but not over the last year. And even if I have outperformed in the last 5 years, it hasn't been a huge kind of outperformance, because some of the largest stocks in my portfolio are some of the largest stocks in the TSX. So it's not an index fund, in terms of tracking the TSX, but it's relatively close. and it's more conservative. So in years where the TSX does well and when the S&P 500 does well, I'll underperform a little bit. And in the years where the market is down, I typically outperform a little bit.
Awesome. It's interesting that you say that, because honestly, I don't benchmark myself. The only thing I benchmark myself to is my financial plan. Yeah, so I know I need to invest at a certain yield. I need to have a certain savings rate so that the cash gets into the portfolio, and I need to have a certain amount of organic dividend growth, and that's it. And I always get this question about benchmarking, but it suggests that we are investing for total return, but I'm not investing for total return. So honestly, I can't really care what an S&P 500 does or whatever they do. Also, my portfolio is not there to beat it. It's there to create me the cash flow so that I can retire at early. So why would I be bothering, right? And for me, total return investing, I could do it, but then I had a whole discussion on Twitter this week, and we had also on the podcast last week. And then what? I find it hard to sell companies, so I don't see myself using a strategy of a 4% withdrawal rate. If the company gives me, let's say, a payout from their profits in the form of dividends, then at least they made the decision for me, which is easier, I imagine. And then having the stable cash flow coming in, I think it suits my character better, and also reduces, the issue of figuring out what stocks to sell in your portfolio, right? So
yeah,
it's quite always a tricky question, this one around the benchmark, because it doesn't resonate with me.
I really like what you said there, because I agree with a lot of it. I track how my portfolio does against the benchmark once a year. Kind of January 3rd, I take a look and I say, okay, did I perform? Did I underperform? Whatever. I put it in a spreadsheet, and then I don't think about it until the next year. And to be honest, the whole reason why I really started to do that was because I would get these questions on Twitter, and I would, like, hey, did you outperform last year? And so I just sort of wanted to know in terms of a just like a curiosity perspective, kind of. But for me, the number one thing that I track, and the number one thing that's important, is that dividend income. And is it going up each year, and is it enough to make sure that I stay retired? And I don't care if I beat the index. If I lose out to the index for the next 30 years, but I remain retired and I can do whatever I want for the next 30 years, am I going to look back at that and say, oh, I failed because I didn't, meet the index? Well, no, because the whole point is the freedom to be independent. And that's what the goal is for me. It's not to beat an index. For some investors, it is to beat an index. And I don't understand that, but hey, if that's their goal, then by all means, that's not my goal.
Exactly.
Oscar has asked how you think about diversification while being retired. Do you spend more time monitoring your holdings?
So I definitely keep an eye on my holdings. And I am quite diversified. And of course, I when I talked about my story there, I talked about how when I first started investing in the stock market, I was quite concentrated, and I had a couple positions sort of blow up on me, and I had a quite poor year, sort of the first year that I was serious in the stock market. Then I said, okay, this isn't going to do. So I embraced kind of a model of pretty wide diversification, and I've got probably about 50 stocks in my portfolio. A lot of people say I'm over diversified, which they have a point. Like I won't kind of necessarily deny that. But for me, it was okay, if the dividend income is the most important and the reliability of that dividend income is most important, then how do I make sure that one dividend cut isn't going to or two or three dividend cuts aren't going to affect my lifestyle? And that was answered by, hey, I'm going to diversify. I'm going to diversify maybe more than what I need to, but in the hopes that if I do mess up and I pick a poor stock and they do cut the dividend, that it's not going to affect my lifestyle in a big way versus having 10% of my assets in one stock.
Yeah,
that creates that risk I don't want to deal with.
It is again kind of like a lot of those typical portfolio construction theories as such apply to total return investing. But when you're a dividend investor wanting to live off dividend income, it doesn't always make sense. Yeah, I understand that if you have more than 15 stocks or something like it, that your risk really doesn't change that much anymore in your portfolio from a total return point of view. Yeah, but from a dividend income point of view, it's a total different ball game, because if then it is a single dividend cutter, you might lose 6-7% of your income, which you simply don't want and maybe even can't afford. So yeah, interesting, really interesting.
Yeah, and I have the time now that I can monitor my 50 plus stocks relatively well. But saying that, if my largest positions, I spend 15 minutes a quarter looking at the sort of the earnings report and the sort of what management has to say. I might read the earnings call transcript. I might not, because these are what I view good companies that I don't have to keep an eye on. And if there's something that I've bought that I really feel the need to analyze it every quarter and kind of go in and spend a lot of time on it, then it's probably not something I should be owning anyway, because it's not a sleep well at night stuff. So I sort of let the portfolio kind of do its own thing. If something goes down, I might kind of say, hey, that's down 10% this year. What's going on with that? And kind of look behind the scenes and see. But ultimately, what I try to focus on is the overall health of the business. And what I find is that, and especially in the kind of the summer and the fall there, when we had that downturn and stocks were down 10, 15, maybe 20%, they went down there. It was just people getting excited over what they view as short-term economic weakness, and for long-term investors like us, well, who cares?
It was a candy store at that time.
Exactly.
It was a candy store. Yeah.
Das Moiki has asked, do you think dividend investors should adjust their exposure to dividend growth or income stocks as they get closer to the FIRE number?
Well, like I kind of said earlier, is that as I hit my FIRE number, and then I'm trying to sort of add a little bit more growth into the portfolio now that I've hit that number. But I think that's sort of the opposite of what a lot of people do or plan to do. Is that I think there's a lot of people out there who want a either total return approach to investing or a much higher dividend growth. They're kind of aiming for, say, like a 10% dividend growth rate until they get relatively close to what they think their retirement age is, and then they're going to sort of transform into this kind of more income oriented kind of investor, which I've always thought was a little bit inefficient. Because it's like you just created this big taxable event by selling all your growth stocks and moving into income stocks. And I just if someone's been successful at investing in growth stocks, and then to kind of change that strategy sort of 180 based on, hey, I'm 50 years old now and I want to retire soon. I don't really understand that. It just find the way that works best for you and kind of keep doing that. But for
That's
me,
interesting.
Yeah. I was gonna say, just for me, that balance is best, and I think that every portfolio should have a little bit of kind of maybe a little bit more growthier component with dividend growth, and some sort of more mature kind of just own a good mix of companies.
Yeah. So Nelson, what I don't understand sometimes, I think because Mike's question was not about growth, but more about dividend growth versus income, right? But there is this narrative often on social media that, yeah, you invest, let's say, in growth stocks, and then at that moment you switch to income. But there's an underlying suggestion that I said, thinking that growth stocks outperform dividend growth stocks over, let's say, a 15-20 year period. I find that quite an astonishing perception, because it means that people are saying effectively that probably for the next 15-20 years, they are beating the S&P 500 because they are investing in growth stocks. I find this very interesting, because if this is the case, those retail investors suddenly should be part of this very exclusive group of super investors that have been able to do this for over more than a decade. So I would love to hear someone, and maybe there's a listener here that knows someone that knows a person that was a growth investor for 15-20 years. Let's say instead of 15 years, did it in 10 years, got retired and switched to dividend growth stocks. I would love to hear the first person.
Yeah, that's a great point, and it just goes against human nature, right? Where you know, someone's a super successful, betting on Tesla or trying to think like Amazon or these big sexy tech stocks, and then all of a sudden it's like you get to a point and then you say, okay, I'm going to change everything despite that strategy working extremely well for you. Like it doesn't make any sense, right? Like I wouldn't do it. Like why would you? So there's certainly that part of it, and that's it. There's growth, and then there's dividend growth, and this whole thing where I get these arguments on Twitter, and I'm sure you guys get the same arguments on Twitter too, where it's like, dividends are stupid, they don't actually create any value, just that same kind of common stuff that people talk about. But at the end of the day, you can get growth investing and dividend investing all at once, of course, dividend growth investing. And there are some really high growth stocks that also offer high dividend growth. I'm thinking of Microsoft off the top of my head. I'm thinking of Costco off the top of my head. Two big American stocks. Apple, yeah, it's another great one. And even in Canada, I'm going to say some names that are a little bit obscure for maybe some of your European listeners especially. But like there's a Dollarama, which is a chain of dollar stores in Canada. It's increased the dividend by 15% a year for the last 15 years. And Equitable Bank is another one where it's not one of the big six banks in Canada. It's kind of this operating at the periphery, but it's increased its dividend by at least 15% a year. I think last year it increased the dividend by 25%. So you can get growth and you can get dividends all at the same time, and that of course is that perfect kind of kind of between zone for people where it's like, hey, you get some growth, you get some dividends, and that's great. And that's the beauty of dividend investing, is there's that spectrum, and there's just whatever you want is there. Unless you want no dividends, then you gotta do something else.
Ronnie has asked us, what's your take on national bias? Are you heavily invested in trains, banks, and mining?
So it's a funny question, because Canada is of course, it's known for banks, mining, oil, and those railroads. And so the answer is I'm very heavily invested in banks, like we talked about. I definitely have both Canadian National Rail and CP Rail in my portfolio. But mining, I only have one mining stock, and it's not actually a miner; it's a royalty company. So they do these deals with these with miners that want to. Hey, we need some money to build a mine. Okay, we'll give you that money, and in exchange, we'll buy the first X amount of production at a discounted price. So it's a mining company, but it's really more of a financial company. So I've got one mining company and then 3 oil stocks. And oil's maybe 5% of my portfolio. It's not a huge weighting. So kind of half of these sectors that Canada is known for, I try to avoid them as much as I can, just because of the commodity price risk. It's like, so in Canada, I don't know if you guys are aware of this. We have this like kind of this like energy Twitter, and there's guys who just analyze the Canadian energy market all day long. Like, this is their thing. They love oil and they're invested in oil. And I know some of these guys and I talk to them, and it's like, these guys follow the market and they got no idea what oil is going to do tomorrow or next week or next month. There's this big thing in the Middle East where Yemeni rebels are shooting rockets at tanker ships. Like, the Middle East is a bit of a cluster right now, and oil's done nothing, as everyone predicted. Like, it just makes no sense. So I don't even try. I don't have a lot in oil. I have a little bit in oil. I don't have anything in mining, because those are kind of what I view as not very good businesses.
Cool. Anders has asked us, what's your experience in what are your experience the largest problem with investing in foreign versus domestic stocks? So for example, as a European, he often finds it difficult to invest in companies from North America due to a lack of familiarity with the company.
I think that's for me, I've chosen to focus on Canada just because there's so much there's so much out there that I think that as a securities analyst, I can only really focus on a small part of the market and really kind of do that effectively. So that's a big issue for me. And the other thing too is you have to, in terms of taxation on dividends and that, for when it comes to investing in certain European stocks, there's withholding taxes. There's kind of these challenges that make it just sort of like a little bit more difficult. One more thing that you have to kind of analyze on top of the fundamentals and the European market and everything. I don't have a lot of insight on what the economy is like in Europe. I sometimes come and visit and walk around and say, hey, nice place, but I don't have an edge there, and that makes it much more difficult. Where I think Canada, my edge is a lot better.
Cool. El Koba has asked about banks, which I think you've answered pretty much already. But an interesting part of his question is, why are real estate investment trusts not so popular in Canada?
So I really like REITs in Canada, and I think it's my real estate background. Like you kind of hinted at there earlier, it's like I understand real estate, I know it. And so I can kind of look at a REIT and I think I can analyze it fairly well. But they're not really that popular in Canada. It's more of like a niche kind of community that really follows REITs. I think part of it is that it's fragmented. There's not really any super big ones. I think the biggest one out there, which is Choice Properties, I believe, is the biggest, has about 8 billion in assets, which is pretty big for Canada, but not super big in terms of sort of the rest of the world. And there's lots of REITs in Canada with 500 million, 750 million, maybe $1 billion in assets. So they're quite small, and there's lots of people that just sort of avoid small cap stocks just in general. The other thing is that there have been quite a few of those REITs that have gotten into trouble during COVID, during the financial crisis in 2008, and they cut their dividends. And a lot of dividend investors, as you guys know, it's as soon as a company cuts the dividend, they just fire it out the door, and it's dead to them forever. So that hurts some of the REITs in Canada. And the other thing is that there are only a few REITs in Canada that really have a history of growing their dividends, where a lot of them just offer sort of flat dividends, or they've cut their dividends, like I said. So that really, really limits the universe and what's already kind of a small universe. And finally, one more thing is that they don't pay dividends in Canada; they pay distributions because of the tax rules, and they do their best to sort of limit the amount of tax that you, as a unit holder, pay, which creates a certain amount of complexity when it comes time to sell. And there are certain investors that kind of realize that and just say, forget it. I'm just going to avoid the whole sector.
Yeah, makes sense. Lewis has asked us about your thoughts on the Brookfield Group. He's given 4 tickers with them. He said they're not well known outside of Canada.
So Brookfield is, I'm not going to quite say a national treasure in Canada because that's a little bit excessive, but they're quite famous inside of Canada, just as this sort of asset manager. There's a long history of Brookfield in terms of, it used to be called Brascan, and it was the Reichman family, which if anyone is interested in just a fascinating story about a family who escaped, I think it was Hungary in the 1930s, came over to Canada in the late 1940s, and 40 years later, they were the largest real estate owners in the world, and developed Canary Wharf in London, and then had too much debt, and the whole thing blew up. And then Brookfield was what came out of the ashes of that Reichman empire. But so Brookfield's a holding company, and then they've got these like operating subsidiaries. So there's Brookfield Infrastructure, which owns like pipelines, which will own like a port. I think they recently bought some cell phone towers in India. You've got Brookfield Renewable Energy, which is hydroelectric, wind power, solar power, etc. And then they're all held in held by the parent, which is Brookfield Corporation. So you've got these subsidiaries which are focused on paying kind of large, sustainable, growing dividends, and the subsidiaries have a good record of kind of that 6 to 8% dividend growth every year. 5% yields right now. So they've been quite successful. And then the parent company is a smaller dividend, but it has excellent dividend growth. There's also the parent company spun off the asset manager, and then the asset manager is the one that looks for acquisitions for these subsidiary companies. So the negative of Brookfield is that it's all kind of complicated, and it's all sort of this Russian nesting doll of companies, and it's hard to understand. Canadians just kind of trust Brookfield and the CEO, Bruce Flatt, which is one of the richest guys in Canada, thanks to the success of Brookfield. They kind of trust him, and perhaps a little bit at their peril in terms of because when you dig into them, they're complicated. It's complicated accounting.
Yeah. And
you have to get comfortable kind of with that. I'm comfortable. I own 2 of the subsidiaries. I own infrastructure and renewable, and I am comfortable, but it took a little while to get comfortable with it for sure. There was some hours with those annual reports.
It sounds like a company I'd stick in the too hard pile and just forget about. Honestly, it sounds complicated, but I have heard of them. I know it's quite popular over in Canada, but as an Irishman, no thank you. I'll stay away.
I mean, that's fair, and there are definitely a lot of people who have invested in the various Brookfield entities that really have no idea kind of what they own because it's so complicated.
Yeah. Oscar has asked to hear your thoughts on TD and BNS, obviously 2 banks.
So TD is probably my favorite bank right now. If I was looking to buy more banks, it would be that one. They looked at acquiring a First Horizon in the U.S., a bank there, and TD is already big in the U.S., so it was sort of viewed as a pretty good acquisition. And then the regulators came and said, "We're not going to approve this, and we're actually worried about your history of money laundering in the United States." And so people freaked out a little bit with that, and right now the regulators are still kind of pondering what the punishment is going to be. They've come out and told TD that, yeah, you're going to get fined, but we just don't know how much. So what happened was that TD raised all this money to buy First Horizon shares, and the deal got squashed. Didn't anticipate it at all. So now they're kind of flush with cash. So what do? Well, they bought back a whole bunch of shares, and it's going to be about kind of 5 or 6% of the company this year. They're going to buy back, which doesn't happen in Canadian banking. Like they just don't buy back shares. So that's a big sort of kind of tailwind for them in the short term that I really like. And the other thing is that the multiple it's about 10 times earnings right now, which for TD is quite cheap. They're usually in that 11 to 12 earnings range. So I'm bullish on TD. I own a bunch, and that would be the one I would buy today. BNS is Scotiabank, which I kind of talked about before, and they've got that stink of Latin America on them. And until they either sell something or the market starts liking Latin America again, it's going to struggle. And I say that as a Scotiabank shareholder because I think it eventually kind of, that attitude changes. I just don't know when it's going to be. So in the meantime, it pays a 6% plus yield, and I'm just happy to kind of sit and take that. And Scotiabank is still, I think they're the number 3 bank in Canada. Like they've got these Canadian operations that are just as good as anyone else's Canadian operations, and so it's just that kind of Latin American, which is 30% of their business, but that's what everyone focuses on.
It seems like whenever a Canadian bank goes outside of Canada, they seem to get themselves into trouble. That's what just from listening to you, that's what it sounds like.
and of course, that's the I talked about National Bank earlier. And that's what a lot of people like about National Bank is they're still small enough that they're expanding inside of Canada, and they're not really screwing around with outside of Canada. They do own a bank in Cambodia, but it's a very, very small part of their business. And so that's it. They're in Canada, and there's a lot of people that like that about National Bank. So they buy that one.
Cool. We've got 2 similar questions from William and Martinez, and it's about Canadian Pacific and Canadian National Railway. Do you have a preference of either?
So I don't have a preference as of this point. I do own more Canadian Pacific than I do Canadian National. What happened was when Canadian Pacific acquired Kansas City Southern, which was I think about a year ago, is the market didn't really like there was a bidding war, if I remember right. Something happened. I can't remember what it was, but the stock kind of fell like a kind of 10-15%. Where, and I looked at that sort of as a rare buying opportunity to get the railroads at a reasonable valuation.
Yeah.
So I bought more Canadian Pacific, but that's the only reason why I own more than Canadian National. From what I've seen long term, the returns are almost identical. So just buy them both and stick them away and forget about it for a long time. And just sort of when they dip and they kind of fall 20% sort of once every 2-3 years, just kind of nibble in and buy some more and have them as good long-term holdings. That's my strategy anyway.
Cool. And Marek has asked us about your thoughts on ticker symbol MFC. So it's Manulife Financial Corporation.
Manulife. So Manulife's a life insurance company, and like the banks, Canada's life insurance world is dominated by 3 companies: Manulife, Sun Life, and Great-West Life. So what Manulife has done especially is these guys have saturated Canada. They moved on to the United States a little bit and kind of grew there, but the United States is a very mature insurance market as well, so it wasn't really that enticing for them. So Manulife moved to Asia, and part of the issue with Manulife is that a lot of their growth in Asia is coming from Hong Kong and China, and of course there's lots of people who are bearish on on both those places. So Manulife gets a little bit punished for that, and because of that, I think the stock trades at about 8 times earnings, which is quite cheap. It's got a 5% plus dividend and a payout ratio pretty well under, I think it's about 45%. So it's solid in terms of like a dividend payer, and you stick it away, and I think the dividend's safe. They cut the dividend in 2008 during the worst of the financial crisis. They got into some mortgage stuff that they shouldn't have. And so that's an issue for a lot of people, and the China thing's an issue for a lot of people. But the Asian part of the business is growing quite well, and the higher interest rates are able to lock in some of their portfolio into that, and that's translated into higher earnings too. So I own Manulife, and I'm happy to hold it for a while.
Cool. Samuel has asked us a question about reinvesting dividends. What's your general strategy into reinvesting dividends? Do you buy directly or save up larger sums to buy whole shares in different companies?
Yeah, so I've never done DRIP plans, the dividend reinvestment plans. I've always taken that money and accumulated it, and then used it to either buy a new position or buy something that I own that I want to buy more of. And it's still like now that I'm in retirement, of course, I all my dividends come as cash, and then I sort of make my capital allocation sort of decisions at that point. But saying that, I see the benefit in DRIPs for a lot of people, because it takes away a decision point. And I think that there are a lot of investors out there who should be more actively trying to minimize the number of decisions they make. Something I've sort of thought about in the last kind of year, where it's like I want to buy something and hold it for a very long time, and I don't want to try to put myself in a position where I have to think about whether I want to keep owning a stock or not. So that's for me the big benefit of DRIPs. But for me, at my point, no, I take them out and either reinvest them manually, or for the most part they end up in my bank account.
Cool. We have a couple more questions. I think they are more aimed at myself and European DJI, so I'll ask him, but feel free to jump in. Thomas asked us, do any of us own ticker symbol BBY, and do we have any thoughts on the company?
So I believe that this is Best Buy.
Best Buy, yeah, that's right.
Yeah, I don't like the kind of business. I don't like electronic stores. I've seen too many go bust around me wherever I am. And if I look around me, it's mostly Amazon and something like Best Buy. It's not over here. It's in America, so I don't have any association with it, because then you want to know like how is the experience there on the website? How quick do they deliver? What's the pricing? I have no feeling for this at all, so I stay away from this. I practice kind of JOMO here, like joy of missing out.
Yeah, these type of companies, we speak a moat. I just don't see it.
Yeah, I was going to say, imagine waking up every morning and competing with Amazon.
Yeah,
exactly. It's
like bash my head against the wall before I do that, I think.
Hussein has asked me. Last year, I made a New Year's resolution, to read one 10K or annual report every single week. And he's asking, was I able to meet that resolution? No, I didn't, but I did read far more than I ever did. So I did read at least one or two a month. But what we have now is we do have our premium newsletter, which we take turns. We write every couple of weeks. So I do one company, and then European does the next one. So it's forcing me to read one at least every 2 weeks. So European DJI is doing his best to force me to make my or realize my New Year's resolutions. But I definitely read a lot more than I did in previous years, so I was quite happy with that. And then the last question is from Tim, and he's asking your thoughts on the recent downgrade and the 52-week low of Ahold Delhaize.
Well, you know that I don't read downgrades and such, right? But just for the preparation of this show, I looked at the downgrade of UBS. There's literally bollocks in there. There's really nothing in there. It writes a little bit about that they expect a little bit less earnings or pressure in America, and then they suddenly reduce the their price by 20 or 30%. It makes absolutely no sense. I tell you what's really happening here. The price went down from 32 euro to 26 euro the last few weeks. And those banks, they look like fools, so they need to adjust their pricing. I think this is what is happening. Price is driving sentiment here, and they probably look like fools for their audience. So they just adjust because logically there's nothing in there. The company has not been reporting in the last 2-3 months. There's not any data that they are referring to other than like they're not referring to like, oh, there's something happened in the United States or something like that. So for me, there's a lot of BS. And what I think about the 52-week low of Ahold Delhaize, I just, we don't give like that stock advice, but generally speaking, I could say if you loved it at 28, then you should, want to die for it at 26.
I agree. Yeah, so that's the last question. So I want to say, Nelson, thank you so much for coming on the show. It's been a real pleasure. I think you're our first retiree on the show, so it was quite insightful. So thank you for your time.
Well, thank you to you guys for having me. I had a lot of fun, and I hope that I can be of a little bit of value to your listeners.
Well, definitely for the two of us already. So, and I'm knowing our listeners, I'm quite confident, Nelson. And yeah, it was just really inspiring to hear you talking. I really feel like I'm a few years behind you. I'll get there. So thanks also for inspiring us.
Well, thank you. And don't worry, you will get there. And just remember to enjoy the journey the best you can, because that's a certain amount of fun.
Definitely. Awesome. And to our listeners, thanks so much for listening, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.